Plastic waste is becoming an increasingly unsustainable problem for existing market solutions. As far as recycling goes, less than 10% of plastic waste is actually recycled per year. The rest ends up in landfills. And I've highlighted a different company that's developing an innovative recycling solution in other videos, Aduro Clean Technologies. But in this video, we're going to talk about another company offering a solution to the plastic problem. This time, instead of recycling that plastic waste back in petroleum products, ORGN Materials is a company that removes oil-based products from the equation entirely. So what does ORGN do? ORGN's primary offering is the production of plant-based plastic from biofeedstocks, like wood chips, pulp waste, and more. That waste can be broken down into chloromethylfurfural, or CMF, and hydrothermal carbon, or HTC, among other components. That CMF can be taken and repurposed into plastic, specifically polyethylene terephthalate, which is the type of plastic used in plastic bags, bottles, or other materials. As you can see here, polyethylene is PET, so around the middle of the pack within the different types of plastic by consumption. Granted, this chart is from 2015, so that may have changed by now. But the ultimate goal for the company is to start making PEF later on, which is polyethylene furanoate. And that's supposed to have a variety of advantages over other types of plastics. And I'm trying my best not to mispronounce these, but forgive me if I am. But HTC is one of the other primary focuses the company has right now, hydrothermal carbon, which is used in activated carbon and ultimately carbon black, which in ORGN's process can be produced without carcinogens, which is an issue with carbon black made from fossil fuels, so that's an improvement there. But carbon black can be used as a replacement in tires, foams, and dyes as well. And this is not to say that those are their only products. You can see a list of everything they're developing so far right here. So there's quite a diverse amount of potential use cases with ORGN's technology. So what are all the advantages? Obviously, you can see that these products can be converted into a variety of different applications. But a key point here is that the technology was designed to be chemically the same as traditional plastic, meaning the current buyers of plastic don't need to change much, if anything, about their machinery to use ORGN's product. Another upside is that because the product is created with wood chips and other renewable inputs, ORGN can produce plastic carbon negatively, meaning that it's actually negative or low carbon, as the usage of plant-based product naturally leads to less usage of oil overall. But the most obvious positive of this technology is because of the use of wood chips and other cheap feedstocks. ORGN's process is actually cost competitive because of that, if not cheaper than traditional products derived from fossil fuels. So not only is the technology better for the environment, which a lot of companies are looking for, but it's also cost competitive. And clearly, that's going to be a true driver for companies to make a change. And you can see it in their ability to build a large backlog of customer demand and offtake agreements. As of February, the company's backlog was around $9.3 billion. And we'll talk about their different partners in a minute. But right now I wanted to discuss the total addressable market. Now, I point out the TAM, not to say, oh, just imagine if they get 1% of the TAM, how much revenue that would be. No, that's not why I pointed out. I say this as a massive TAM of over $1 trillion to point out that there's plenty of room for competitors in this market, which there will be plenty. When you see a TAM of this size on a company's slide deck, they're essentially telling you that there's going to be a wide variety of competitors, at least later on. But it will be used to attract as much investor interest as possible right now, of course. But with that said, ORGN does have several potential moats that they can build here. So they're already better off than most of the possible ESG-related companies to invest in my book anyway. They can build economies of scale through building large manufacturing facilities, which they're in the process of scaling right now. Their first facility, ORGN 1, is mechanically complete and set to begin production pretty soon here. More on that in a minute. But another moat is intellectual property and patents around their process, which they already have so far. It took the company a decade to develop its technology, so competitors certainly can't just come in and immediately copy them overnight. But how are they going to build and fund those plants that I mentioned? Well, they still have around $300 million in funding from their SPAC deal in 2021, which was at around a $1.8 billion valuation at the time. And now the stock sits at around a $600 million market cap. So the stock is down around 60% since the SPAC occurred. But in total, ORGN received $900 million, including investment from Danone, Nestle, and Pepsi, who, interestingly enough, have been supporting the company's developments for quite some time now, with Pepsi supporting ORGN since 2018, with Nestle and Danone before that. So the company has some pretty strong partnerships there, other notable ones being Ford, as well as Mitsubishi. But as previously mentioned, ORGN 1 is mechanically complete. It was expected to be fully operational around this time. So news could be out about that pretty soon here, if it's not delayed. The facility has a capacity for around 25,000 tons of biomass annually. With ORGN 2, their next plant, which is set to be significantly larger, the capacity of ORGN 2 is going to be around 1 million tons annually. So quite a big gap there. Construction is set to start in mid-2023 for ORGN 2, and they don't expect to have it operational until around mid-2025. Then the third plant of similar size is set to be completed in 2027, and the list goes on from there. Projecting to build more plants at a faster rate as economies of scale start to pick up. Now, everything sounds great so far, but the business model itself is where things kind of break down for me personally. Let me explain. Another company that I mentioned earlier and in previous videos is Aduro Clean Technologies, a company I'm a shareholder of. One of the reasons their stock is so appealing is because they're taking a licensing route to their technology and ultimately how they're going to generate most of their revenue. Now, ORGN Materials, on the other hand, is building out all their plants themselves, with help from engineering firms, of course. But ORGN is providing all the capital and the majority of the labor. That's a capital-intensive business model right there. Now, ORGN knows this, but they do have some advantages compared to a lot of other companies in the general manufacturing space. Like converting some of the equipment found in aging or defunct pulp mills, or just the fact that their inputs, the wood chips and other feedstock, are quite cheap overall. And ORGN could potentially charge more for their product if there's a limited amount of options for carbon negative materials. So there's some ability to cost save there, but ultimately, they still have to put up a substantial amount of capital to build out these plants, and that's going to hurt margins. We can see ORGN 1 is not profitable straight up, gross profit's negative, but we'll want to focus on the long-term economics here, for the second plant and beyond. And the gross profit per plant, minus depreciation and amortization, is going to be around $385 million, which is around 50%, so not bad. But given the nature of their business, building out large manufacturing facilities, the usage of EBITDA here concerns me to some extent. Because if they want to focus on EBITDA to exclude depreciation and amortization in their projections, that tells me these margins aren't going to be so great when we start seeing what the net income actually looks like. Actually looking at proper gross and operating margin projections might not be as appealing. But ultimately, that's kind of to be expected. The company will certainly reach profitability if they get a few plants running. That's not really the question. It's just about how much of that money actually hits the bottom line. Now, it's not a requirement that a company has good margins to perform well as a stock. Walmart and other large capital-intensive companies are perfect examples of this. Walmart actually has a profit margin of just 2%, and it's one of the best performing stocks of all time. But investing in companies with low margins tends to lead to less capital return to shareholders overall, as a business needs more capex to. So it can take longer to achieve the same returns on a stock, all else being equal. And that's the major gripe that I have with this company. The management team seems like they'll be able to pull this off pretty effectively. They've certainly got the name recognition and partners in place to help them build out these plants. So I don't think of execution as too much of a concern here. And they also have a list of their technical, operational, and commercial teams and 5 slides at the end of their corporate presentation as well. A lot of experience in the engineering and petrochemical industry here. But if we take a quick look at their financials, as mentioned earlier, they have around $300 million in cash as of the end of last year in December, which is enough to fully fund the completion of ORGN 1 and ORGN 2. They also only have $19 million in debt, so that's not something to worry about anytime soon as well. The outstanding shares sit at 138 million currently, but if you include warrants, legacy earnout shares, options, and RSUs, that puts us at 221 million shares in total. The exercise price for those warrants being $11.50. So this could mean some pretty significant dilution. Granted, this would all contribute to the funding of ORGN 3 and potentially beyond. So that's something to consider as well. Lastly, as for insider ownership, it certainly could be better, around 6.5%. I'm typically looking for over 10 at least, but they do own some of the company, and it is larger than most of the companies I tend to look at in market cap. So make of that what you will. But all these recent transactions have been selling. No one's been buying for quite some time, it looks like, as far as insider ownership goes. So, yeah, in conclusion, I'm not saying this company is going to fail by any means. But with their backlog, it looks like they're going to do quite well, actually. But for me, running a concentrated portfolio, I don't see why I'd buy ORGN, which would have a worse business model from a margin standpoint than all the companies I currently own. But if you're interested in ORGN or already invested, I'd suggest checking out my videos on Aduro Clean Technologies. I think the companies are relatively similar in nature, but as I mentioned, Aduro is going the licensing route instead. Granted, Aduro is not as far along in the commercialization process as ORGN, as Aduro is still building out pilot plants to test the scalability of its tech. Meanwhile, ORGN's already completed all that testing they really need to do, building out larger operational facilities already. But if you want to learn more about Aduro, I'll link an introductory video on the company in the description below. But thanks for watching, and I'll see you in the next one.